Welcome back. I'm speaking with three of the top minds from JP Morgan. I've been speaking with Leo Puri, Jahangir Aziz, and Sajid Chinoy. We spoke about the good India growth story, the India shining story, but global slowdown can cast some shadows, and that's where we ended the first segment. So, Jahangir, straight away that to you. How bad can the global slowdown get, you think? I'm not worried about the more near-term 75 basis, 100 basis rate hikes. But can the terminal Fed funds rate go well over 4% and stay that way for a longish bit?
Look, I mean, that is most likely to happen that, the terminal Fed, not just the terminal Fed funds rate, but other DM central banks like the ECB and the Bank of England, and maybe sometimes even in 2023, who knows, you could even have Bank of Japan joining that group, that interest rates will have to be lifted. And the reason why interest rates have to be lifted is because, the fears of recession, etc., that, we all went through in June and July. None of those have actually come true. In fact, the US is most likely to deliver about 1.2, 1.3% of positive annualized growth in the second half of the year, as opposed to minus 1.2. There is a recession that we are looking at in the case of Europe because of the energy price shock. But given the fiscal support that has taken place in England, in UK and in Europe so far, most likely that is going to be a bit shallower. China will get out of the zero COVID policy at some point in time, and the policy stimulus will hit through. The point I'm to make, Lata, is that while global growth is likely to slow in terms of what we were used to, let's say back in 2019 and before, I think it is not going to happen that quickly and that steeply. And as a result of that, most likely you will see labor markets remaining reasonably strong, and central banks therefore being forced to react much more aggressively than one would have expected, let's say in June and July, when these fears of recessions had more or less covered all our growth forecasts. Okay. We are in a very different place at this point in time.
Yeah, I read your report, and it does say that you all are not expecting things to be that bad, actually, and that's why you're even increasing the terminal Fed funds rate. But Jahangir, I don't think enough attention has been placed on quantitative tightening. The Fed's quantitative tightening increases from now on, and they could, after all, they've not withdrawn anything. If you compare to 2020 levels, their balance sheet doubled as of end 2021 from 4.5 trillion to nearly 9 trillion. And even if they go by the current pace of tightening, they would have barely taken off 6-7% of that. Will the tightening, is that tightening sufficiently analyzed, and can it
quantitative tightening on one hand, and making sure that the quantitative tightening that that is ongoing is separated from the interest rate measures that they've taken. So if you look at the quantitative tightening, it is basically on autopilot. It is on an autopilot where it will take at least 2 years before we get down to something even close to what was the case prior to the pandemic. So it's a very slow absorption of liquidity. And all of that is done precisely for the arguments that you made. That missteps there, and we saw that in September of 2019, that even a small misstep there can create significant amount of repercussions in rates market and therefore to other asset prices. And I think the Fed is trying to be very careful with that. Now, will this experiment end without further accidents or accidents that might happen that are clearly, unintentional? Look, only time will tell. We never ever have gone through this process where we've done this amount of QE and then tried to take that amount out. But at this point in time, I think by keeping it on autopilot, by making it very, very slow, almost making it, as you pointed out, it's almost like watching the paint dry. Yes. That's the pace at which they're taking out liquidity. I think they are basically trying to make sure that you don't get these accidents. And, you know, right now, we can all hope for the best.
Yeah, but we have to keep that possibility on the radar. Sajid, which straight away brings me to the rupee. Should we worry that there can be external attacks? You know, if the Fed doesn't go beyond 4.5% or 4%, which seems to be the JPM base case, then perhaps we will tide over. But can there be, you know, big attacks from the external front for India? After all, we do have a large current account deficit. What is your own estimate, and what should we expect in terms of possible external dangers?
So Lata, I would say, you know, there is no need to panic because this is not 2013 in an important way. We've got significantly more buffers in place. FX reserves, if I judge it by import cover, still at 9 months today, it was 6 months then. If I look at gross financing requirements, it's 1.5 times now, it was 1 time then. So there's no reason for panic, and this is not 2013. The larger question is whether we should use the rupee as a shock absorber. And I've consistently had the view that faced with the current account deficit, which will be elevated this year, close to 4% of GDP because of a huge pickup in commodity prices, there are only 2 ways to bring the current account down. One is you slam the brakes on growth and choke off imports, which clearly we don't want to do in India, given the state of the recovery. The second is to use the rupee to achieve a narrowing of external imbalances and a weaker real effective exchange rate. That weakness can happen in a calibrated manner over time. Has been seen in the past over time to boost exports, bring down imports, and thereby narrow the current account. And actually, it's expansionary. Remember, a weaker rupee helps domestic growth. So in an environment where fiscal deficits are tightening and monetary policy is normalizing, you want a weaker currency to actually help you with growth along with capital expenditure. So I'll just end by saying this is different from 2030. The pressures are clearly there. If the dollar continues to strengthen, make no mistake, emerging markets will be under pressure. But it's different in the sense that we're not scrambling like we were in 2030, and there should be no panic. The question is how we use it as a policy instrument to narrow, elevated external imbalance.
But RBI's big fear is that you allow a depreciation of some magnitude, and it can become self-fulfilling and therefore generate instability. So I think they worry about that a goodish bit. But before I get to Leo, the more important question, and I will of course have occasion to discuss that with you in our Citizens MPC. But do you think that the Reserve Bank has a lot more heavy lifting to do? 50 basis next week?
We would expect a 50 basis point next week, Lata, just given what we've seen in the US CPI, where the Fed has to move. The fact is, as the RBI pointed out, inflation, at least for the next 6 to 7 months, is going to remain stubbornly above the 6% upper tolerance band. Monetary conditions are still very accommodative. Real rates are still negative. So I would agree with the RBI's approach in the last 3 months that the more you front load monetary policy, the lower the medium-term growth sacrifice and the lower you need to end up doing. So I would expect there to be another 50 basis point hike next week, to get real rates into positive territory in an ominously worrying world.
Sure. Now, to wind up, I want to get back to Mr. Puri. Mr. Puri, I knew you primarily as a banking expert in your earlier years in India. Now, the Indian financial sector is gone paces because of digitization and the arrival of fintechs, UPI, ONDC. Can all this considerably brighten the medium-term India story?
Well, actually, Lata, this is genuinely a bright spot. In fact, I find it astonishing that there is so little discussion today, and it's good news there's little discussion about the financial sector, because we have actually solved many of the dire problems that we had 4 or 5 years ago. Today, you have a sector where, in fact, credit is back to around 15% growth. Generally, Tier 1 ratios are healthy at all the major banks. We've carried out a process of banking consolidation, which is actually quite remarkable in terms of repositioning industry structure. And we've done this by actually having an industry context where ROEs are well above our Asian peers, let alone global peers. So today we have banks that are well positioned to support capital expenditure, investment-led growth, and it's just a matter of the demand and animal spirits coming back. But this has truly been a success story. We do have a healthy banking system today, and I think that's something which is a very strong foundation for the good news, if you like, if we can take it, the good news for India in a geopolitical context, which is what I highlighted at the outset. So this will be, we have to play the cards we're dealt with. I agree with my colleagues on the global caution. We can't be complacent. That's going to happen whether we like it or not. But in terms of what's within our control, I think we're about as ready as we ever have been to kind of attempt another, space launch for the Indian economy.
Oh, thank you, Mr. Puri, Jahangir and Sajid. That's a great way to end the conversation. This is a superb medium-term and longer-term story, both because globally we are seen as well-placed and because internally there is a wave of digitization, especially in finance, which can distribute the goodies of growth to more people. But there is flashing amber in the near term on the twin deficits, so we have to watch our way. Thank you very much for joining me in this very special chat with the JPM Brains Trust.